Let's start this off. Why is it important to understand the beliefs of investors?
The as an industry, we are awash with past performance data about markets, products, portfolios. Um, it inundates us. But when have you actually asked your clients what they actually believe about the future? And
Hmm.
yet, if you think about it, if you do a financial forecast for a client, if you do a wealth forecast, you obviously have capital markets assumptions which are about the future. In academia, all those financial formulas, even just a simple Sharp, um, you know, Sharp model. That's all based on expected returns, not historic realized returns. But I bet you no one in a finance class ever said to you, "Oh, here's a time series of expected returns, so you know what we're talking about," as opposed to
Hmm.
realized returns.
Hmm.
And so my co-authors and I decided to do is actually build a time series and not just a one-off. There are actually a lot of surveys out there. There's one from Duke. There's one from the American Association of Individual Investors. If you're in the institutional market, there are lots of institutional consultants who ask you once a year, what do you think the 10-year return on global stocks will be? But we thought we'd bring that home to a real live time series with a group of consequential investors, buy and hold Vanguard investors. And I have to
Hmm.
give credit to my co-authors who are Matteo Maggiore at Stanford, Johannes Strobel at NYU, Stefano Giglio at Yale, because they really came up with the idea. But once they approached me with it, I was really excited about it because actually for years I'd worked in this marketplace and never really thought about what do actually investors believe about the future.
Hmm.
That's why we're excited to study it.
Hmm.
Interesting. Steve, how do you describe your unique empirical approach to studying beliefs?
Well, it's survey based, and as I said, there are some surveys out there, but they don't get a lot of press because they're episodic. So this is going to be bi-weekly. It's going to be very simple. So you could do this on your phone in 5 minutes. We're going to ask short questions about short and long run stock market returns, interest rates, economic growth. We also had a really interesting, innovative way of asking people to take 100 points and build their own personal variance of the 1 year
Hmm.
stock returns. So, what are the chances that stocks will do worse than minus 30%, minus 30 to 10, 10 to 30, 30 to 40, and 40 and above? So, you actually had to sprinkle your 100 points across this distribution, and we got these sort of
Hmm.
personalized estimates of variance, which is kind of hard to believe that people would be willing to do this, to be honest with you. And the other thing that was kind of interesting about our survey is we never asked people to drop out. If we sent you 3 or 4 emails and you never responded, we pulled you out because we didn't want, there's a Vanguard client service principle here, which is not to annoy
Hmm.
people too much
Hmm.
with market research. But so you might, if you responded to every, you might be a serial responder, respond to every survey. You might drop in and drop out. But if you dropped out, we would then replace you with someone else statistically similar. And so we got this time series component that we really wanted to see variation across time and within a person. So that was really exciting. So those were sort of particular innovations. And of course, then we married it in an anonymous way, in a data secure way. So all the data was residing on Vanguard servers, totally secure, totally anonymous. We actually merged it with portfolio data to see what people were actually doing with their holdings.
Yeah, that part's crazy. So you've got Vanguard customers. You're asking them for pretty high frequency data about their expectations, and then you can actually see how that relates to what they're doing in their Vanguard accounts.
That's right. That's right. But that's actually a really good point. I forgot to mention this, that one thing is true that this is a Vanguard only sample. It's mostly what are called retail direct clients, clients who go online and manage their accounts. It has a sampling of 401k participants as well. But Vanguard is the ultimate strategic asset allocation firm. Like what you trade in response to market information. That just doesn't. I mean, you might trade in response to your personal beliefs or not personal beliefs, but changing personal circumstances, changing risk tolerance, changing tax status, family status, whatever. But Vanguard is the ultimate strategic asset allocation firm. So the way to think about these results is not all investors, particularly it's not active traders, but it's about a very consequential group, which are buy and hold investors.
Hmm.
And that's why we position it that way.
Can you talk about the benefits of using survey data?
Well, it's the only way to get into people's heads, right? Um, there with the explosion of big data coming off of any kind of system, you can do a lot of analysis about people's behavior, but you can never really understand the rationale behind that behavior. And what's great about survey data is you can ask people what's their rationale, what's their thinking. And of course, you frame it in particular ways, but with particular types of questions you ask. But that's why this marriage really of survey data and administrative data is particularly powerful in financial services. It's a big trend in empirical research in household finance, even in this paper is sort of household finance, but it's also a bit of macro finance because it has to deal with broader questions about valuations of asset classes and expected returns on asset classes. But this marriage of the two is really quite powerful.
And overall, how informative is survey data about individuals' portfolio decisions?
Well, it's really we go to the administrative data for the portfolio decisions. That's one of the things we do, which is actually quite beneficial because, if you ask people, did you trade last month? They roll their eyes. Maybe I did, maybe I did. Or you ask them what their equity allocation was of their Vanguard IRA or taxable brokerage account, they probably make up a number and there'd be a big error term in it. But this way we could actually go to the administrative data to get the actual holdings and behavior and the intention in the survey data.
So, what effect do individual beliefs have on portfolio equity shares?
So I should say, so we have 5 facts that we were struggling with how to organize the results, and we just decided to come up with 5 big facts about investor beliefs and how it affects portfolio behavior. And before I dive into the first one, which is how does it affect portfolio allocation shares, I just thought I'd give, for the benefit of the listeners, some idea of the numbers we gather. What our expectations is, because I'm talking about them in an abstract. So this is from the August 2024, the most recent wave of the Vanguard survey. And if anyone's interested, just go to a search engine, type in Vanguard Expectations Survey, and it'll pop up. Just to give you an idea, these are averages across about 2,000 respondents per wave. Stocks, 1-year expected return of 6.2%. That was the mean expected return. By the way, 2 years ago, that was in the 4s. So 1-year returns are extremely volatile based on market conditions. They sort of go up and down. The 10-year return was 7.9% annualized, so almost 8%. That is the highest it's ever been since we started in 2017. So it's way up, and it's been drifting higher. But this is, again, August 2024. I have no explanation for that, by the way, other than it's too early for the election. It's too early for the election post-bubble. I don't know what was going on. Is it a political explanation? Is the economic news? Is it investor expectations catching up with, oh gosh, the market's up 20%. I can't really believe in low rates of return. I don't know. Economic growth, 3-year, one of the highest numbers ever, 3-year expected economic growth rate of 3.5% real, and the 10-year number, first time it broached 4%. So there was this really interesting peak in August 2024 that we have to analyze. But the other thing, you remember I mentioned we asked people for the estimated variance, and the lower side of that distribution, what's the chance that stocks will lose more than 30%? Is what we call the probability of a disaster, a stock market disaster. And in August, it was 4.4%, but it had been 2 years earlier as high as 8%.
Wow.
And that was actually a peak. So it's very interesting. That number moves around a bit. It's quite interesting. But anyway, to get that, so it gives you a flavor for the numbers. And now what's fact one? Fact one is when I become more optimistic or less optimistic about equities, my portfolio allocation barely moves. And specifically, if I think stocks are going to yield 1 percentage point more over the coming year, I'll only change my equity allocation by 0.7%, which is like less than 1%, right? That's kind of negligible. It suggests a very sluggish behavioral response to information, changing expectations. The other interesting thing is when we did this, we sort of said, well, if your portfolio allocation doesn't really vary based on your changes in your expected returns, how does it change based on that variance we asked you to construct? If the variance got bigger, had no effect. And basic finance says I should demand a higher expected return in response to variance, and there's no relationship. But the downside risk had a huge influence. So if I was more concerned about downside risk, I put less in equities. If I was less concerned about downside risk, a disaster, I was more willing to put in equities. So it really, and you might notice this from client discussions. Clients respond when thinking about portfolio allocations. They tend to respond more to the disaster scenario than some average theory like about a variance. I don't know if you see that. Yeah.
Yeah. Oh yeah, for sure.
Yeah. Well, it's classic prospect theory, isn't it? Loss aversion.
Probably. It is. Yeah. And so that's the first, we didn't really trumpet that much, but that's actually quite a striking finding that portfolio allocations are based on downside risk rather than an extreme downside risk, like the chance of a disaster rather than chance of a loss.
So interesting.
Yeah.
I want to comment on your August numbers for a sec before we move on to the next question. So we did an episode recently, Mark and I, where we talked about a 2020 paper from Lubosh Pastor, Political Cycles and Stock Returns. Mm-hmm. Are you familiar with it?
I've heard of it, but I haven't read it. Sorry. So
it's basically like when risk aversion is high, expected stock returns tend to be high, and Democratic presidents tend to be elected. And the main, like the headline empirical fact that they're discussing in the paper is that pretty much all of the equity risk premium from 1927 to 2015 over 3-month treasury bills has been earned under Democratic presidents. And so the theory behind it is, well, risk aversion is high when Democrats get elected and risk aversion is low when Republicans get elected. And obviously we just had a Republican get elected. Okay. And based on the numbers that you just talked about, people seem to have really high expectations and low assessments of crash probability. Just seems interesting, very interesting.
Mm-hmm.
Possibly related, but it was. Oh, sorry, you were going to say, Mark.
No.
Okay.
I'm just nodding along.
I was just going to say the thing is this was in the field mid-August, so that's post Democratic convention, post.
But look at markets have only gone up and up and up since then, right? Like I would guess that those numbers have probably only gotten higher if you were to do the survey again now. I would guess.
Well, stay tuned.
Yeah,
it'll be out shortly.
Yeah. Okay, that's good.
Yeah, super interesting.
Yeah, so it was in the field just before the election. Sorry, go ahead. Anyway.
Yeah. No. So how does equity sensitivity to beliefs vary with things like wealth, attention, trading frequency, and confidence?
These probably won't surprise you that if you're wealthier, you're more likely to reshape your portfolio in response to your expectations, maybe because you have more wealth at stake. So you want to have a greater alignment between what you believe and what's in your portfolio. That's at least the hypothesis. This idea, attention, I don't know how familiar your listeners are to this term, financial attention. That's the time that you spend actually looking at your account online. In fact, I did a paper about this years ago. It's just super fascinating. When markets are up, people look. When markets are down, people don't look. But in general, in financial attention here, the more you attend to your account digitally, the more likely you are to keep to move in response to change beliefs. Same thing. What else do we say? Trading frequency, confidence. They're sort of all the indicators that you're more actively engaged and therefore more likely to align your portfolio more quickly at the margin to your changing beliefs, either going up or going down.
Right. You alluded to this earlier. How does the observed sensitivity of equity shares to beliefs, which you said is pretty low, compare to the predictions of an asset pricing model?
So this is one of those, I am with very esteemed macro finance guys who, this is a very important point from a macro finance point of view, which is that there's a standard frictionless Robert Merton model. And if your expectations in that model went up by 1%, in other words, say you think the stocks are going to earn 6%, 5%, 6% over the next year, and you went to 7, you should raise your equity allocations by 5, 6, 7 percentage points. And to be honest with you, if we were thinking about this from a portfolio management perspective, we'd probably agree with that too. That if you really want to have skin in the game, you have to move your portfolio by at least 5 percentage points, right? That's what the Merton model predicts. But I think what we point out in the paper, and I think that it's intuitively what everyone understands, is first of all, there's this major behavioral constraint, the cognitive bandwidth of you have a life, it's full of things. And over here is managing your portfolio and trying to respond to that changing belief. And then there's also the issue of capital gains taxes and taxable accounts. And then there's also just the administrative time. Oh, I have to get to a computer. I don't want to do it on my app because I want to do it on a computer, but I'm busy at work and I don't want to do it at work. And the sort of administrative burden. So there are all these frictions, and that's why it this result suggests for academic finance that it's really these friction models that we have to pay attention to when we think about investor behavior.
So how do beliefs affect individuals' trading behavior then?
So that's fact two. Fact two is, so if that's how they allocate, how do they trade? Well, it turns out our sample is about this was about 3.5 years, because every other month. So it's not that great. It's not like a 10-year data set, but it's still a substantial period of time. And the answer is it doesn't affect trading at all. There's no relationship between levels of trading. It doesn't cause people to trade more. But if your belief has changed, you're more likely to change the trade direction and magnitude in the direction of your changing belief. So if you're more likely to think stocks are going to go up, you're more likely to move more money into stocks, and the direction will be, of course, into stocks as opposed to away from stocks. So that's this sort of, it affects magnitude and direction of trading. Well, you don't see people like trading at higher rates because their beliefs are not more positive. You don't see them trading at lower rates. They seem to be trading episodically related, not to their changing beliefs. That might change if you had a 10-year data set, maybe if you had a more active trading population as well. So
yeah, interesting. What about belief heterogeneity? Like, are beliefs shared by similar demographic groups, or are they unique to individuals?
There aren't any really, and we only have a limited number of demographic factors in our data, and there's not really a strong relationship with demographics. There are some minor ones, but the most interesting, and this is our fact 3, we're working through the 5 facts. The most interesting thing here is, and actually I think this is the one most relevant for practitioners, is that at least half of your belief is determined by whether your prior belief, whether you're a pessimist, whether you're an optimist, or whether you're in the middle of the road. There's just persistence in beliefs. In other words, it's not like this month in this wave of the survey, I'm a real gung-ho for the stock market. 2 months later, I'm a real pessimist. 2 months later, I'm in middle of the roader. It's like the optimists are cruising along being optimistic, and the pessimists are cruising along being pessimistic. And this is why I actually think an interesting exercise for advisors to consider, and I've had this discussion when this paper, some of the initial results first came out with some advisor groups that worked with Vanguard, is actually it'd be interesting to talk to clients, get them to tell you what their beliefs are, and then look at the Vanguard distribution and say they're a pessimist, they're an optimist, they're somewhere in the middle. And it might help have better performance-related conversations, but also might lead to better conversations about expectations for the future. I don't know. I just thought there's something here that might be worth providing. I don't know. Do you guys ask about expected returns of clients?
That we do not. We
Yeah,
tell
no one
clients
does.
what our expected returns are. Yeah, but that's a really interesting idea, because it is really the difference between the client's expectation and the actual outcome that they care about.
Right.
Yeah,
And it's really hard, if you asked me And before I started this project, I might have said a lot of people base it on the old Ibbotson numbers because people
Mm,
publish charts with 10 or 12, depending on whether they're doing geometric arithmetic means.
hmm
And people would say 10 to 12, 10 to 12. And maybe they were more, but if you think about it, for the average client, whether they're self-directed or advised, where do they get that information from? But historic data. And uh, but I don't know that people actually could articulate it. I don't think I could have given you a specific number until I had to fill out our survey questionnaire.
Yeah, no, I couldn't
Yeah.
either. I would probably guess something like 10% because a lot of people, if you just look online at people talking about expected returns and what they use in their financial plan,
Right.
a lot of people say 10%, 10%, which I think is crazy.
Crazy. Yeah. Yeah.
Mhm.
Yeah.
But how about it as an expectation for a globally diversified stock index? Even that seems crazy at today's valuation
If we,
levels.
yeah, yeah. I've done a video and probably a podcast episode on this too, where you said like, is 10% a reasonable expectation for stock returns? Then you go and look at historical US stock returns and it's like one relatively recent chunk of US historical returns are around 10% a year. But if you go back further, or if you extend to other countries, or if you look at
Yeah. Yeah.
expected returns for US stocks, it falls apart pretty quickly. Anyway,
Well,
Anyway.
those are index returns too, right? Like that assumes you actually capture those returns and there's fees involved, and yeah.
yeah, true.
And people just like
I've
round
always
numbers.
been a
10% sounds
pessimist
nice.
anyway. I'm still stuck at 6.
It's a really
saw-
interesting point you make though, because people like, and Ben, you've worked with clients for a long time. If you've worked for any amount of time with clients, you can kind of tell if they're a perpetual pessimist or an optimist. And so I
yeah,
think it's a
yeah.
really interesting way to talk to them about their expectations.
Yeah.
Yeah, I think Vanguard has an investment strategy group publishes an annual forecast. And when we first did this, the numbers were they were all single digit of 10 years and 1 year returns on stocks that we thought these millions of people can't be reading research publication from the investment strategy group, no matter how much we were proud of it. So how did they develop these low single digit expectations? And then I was listening recently, I think it was Goldman out of New York issued a big paper on US, it might have been US or global. It was 4% nominal, 1% real. So there is this information that's filtering out to investors. That's their view. But that was very interesting that they took, that of course maybe caught my attention, maybe your attention because we're in the field. But it's that kind of information that might perhaps is shaping these single digit numbers, even when we blow through 20% a year. Yeah.
Yeah,
Anyway.
maybe it's priming them. Okay, so what effect do investors' cash flow expectations have on their expectations of future stock returns?
So as you can imagine, the classic stock prices are a function of expected future dividends, but we weren't about to ask people about expected future dividends on the US stock market. It's kind of obscure question that only a few people know about. So we asked as a proxy for cash flows. We asked growth rates in the economy. We asked about real growth rates, which is itself a challenge. And what you saw, this is fact 4, there's a pretty clear alignment, between cash flows and expected returns. So that's encouraging, right? In other words, the people who are more optimistic about the economy are more optimistic about stock market returns. The people who are more pessimistic about the economy are more pessimistic about returns. So there is a general alignment, which was nice to see from a academic perspective, and actually showed a coherent response by investors, something they really understood, that if you were gung-ho about the economy, you should be gung-ho about stocks as well. These consistent beliefs.
Interesting. So that one lines up with kind of the theory.
Well, it does, but the takeaway for theory, if you want to go down a little bit of an academic rabbit hole for a moment, is so a lot of models of sort of the equilibrium value of stock prices are based on a single representative agent, that looks and sees expected future dividends and has expectations for future stock market returns. And a way to think about this, and we do this in the paper, is we use this so-called Campbell-Shiller decomposition. It's pretty well known that the logarithm of the price dividend ratio of the stock market, which we can all observe, right, is equal to the expected future change in dividends minus the change in the discount rates or expected returns. And in this model, in the model we were just talking about, there are optimists, and the optimists believe they're going to be great dividends, but they also believe in high returns, and the returns discount the dividends, the price dividend ratio in the market. And then the pessimists, they believe in low cash flow, but they also believe in low returns, which are used to that's the discounting factor on their cash flows. And the result of that is they both arrive at the single discounted rate in the marketplace. So that now we're not talking about a representative agent pricing securities, but we're talking about groups of people with different beliefs, beliefs about cash flows and beliefs about discount rates. And that's actually a much more robust theory. And that's I think if you had to ask our academic friends, one of the major contributions is to say this is sort of the path forward for academic development, thinking about the valuation, the overall valuation of stock prices. It's not single representative agent model, but these sort of tiers of people with different beliefs all competing. We all observe the same price, like the market closes on a specific price at a specific day, and we have some general view of aggregate dividends, but to get a price dividend ratio today, but it's where we disagree is the other two components. So that's the inside baseball version of that.
Wow,
Yeah.
very interesting. Okay, so how do investors' subjective probabilities of stock market disasters affect their expectations for future stock returns?
So this is my favorite belief because it's all about stock market disasters. And I'm the guy who in 2024, when everyone says, market's up, whatever it is throughout the year, I always say, and what do you think the chances next year will be down 35 or 40%? I'm always thinking about that. I think I'm in one of those pessimistic groups,
Yeah.
a slightly more conservative allocation. Anyway, so we asked about this probability of greater than 30% drops, and so no surprise, what it if I believe there's a greater chance of a stock market disaster, I believe in lower overall stock market returns. So a bigger stock market disaster, lower overall stock market returns. Small stock market disaster, higher overall returns. So that's what we found.
How does that one line up with theory?
Well, and that's the other sort of aha moment that from this paper from an academic finance perspective, which is the theory is if I believe there is a greater probability of a disaster, I should demand a higher expected return. That's what we've all been taught. That's sort of standard models. But in fact, the way this model is, there's a group of people who have had this distribution, big disaster probability, mean shifted left. There's people with this probability distribution, small disaster probability, mean shifted right. And it gets to it's a very different model than, if there's this big stock market disaster, my mean should be way over here to compensate me for it. So that's a very interesting example where the beliefs did not line up with the sort of classic explanation for why you should demand a higher stock market return.
Jeez,
as an investor.
That's really interesting.
Yeah, that is. So that's where I think some of these facts we organize, some of them are really just takeaways for the empirical finance community to think about the next generation of models for thinking about how we think about risk and return and overall valuation levels in the market. But as you can see, some of these are pretty profound ideas. Like you don't allocate based on the variance of the portfolio, you allocate based on the downside risk.
Yeah, that's really interesting.
If there's a greater probability of a disaster, you demand less. No, you expect less.
Yeah.
So speaking of stock market disasters, how did investor expectations about economic growth and stock returns change during the COVID-19 stock market crash?
So here we were going along administering our survey, and it was February 2020.
Oh, wow.
And we had our regular administrative meeting, and we organized it, and it was in the field, and then the whole world fell apart.
Mm-hmm.
And one of the great benefits of this survey, and I have to thank our marketing research partners, they were so nimble about this is they said, well, they had worked with us on this process. Let's do a special survey right in the middle of the market collapse. The stocks, it turned out stocks peaked early February globally, and we were in the field 2 weeks later, and then stocks went like this. And then so we went into the field off cycle in March and then in April, and we did this analysis. And it's I was looking at some of the numbers. They're not too surprising. So we have February to March with the data point, and pardon me, to April with the data point in the middle. So no surprise, expected returns fell, but surprisingly, we're still positive. So until the crash, they were hovering. Investors were saying we think the market's going to do 5-6% a year. 2 months later, they were 1-2% a year. Actually fell a little bit late, small. They didn't go negative, which I found interesting. Obviously, there were plenty of people saying negative returns, but the mean did not go negative. The probability of disaster, let me look at my notes, doubled. No surprise. People were more worried about a potential disaster. But 10-year expected returns rose slightly. So this is April. I think they drifted down a little bit later in the year, but as of April, people were thinking this is not going to affect 10-year returns. In fact, it might be slightly more positive because prices had fallen, so expected returns should rise slightly over the next decade. And the same thing sort of happened in the economy. There was a slowdown in expectations for economic growth, but nothing like what happened, say, during the global financial crisis when rolling 3-year GDP was like 0.3%. We were still at clients, the mean was still around 2. I think it was 2.2. So it wasn't like there wasn't an anticipation of sort of major economic contraction, even though in fact there was, but perhaps unanticipated because of no one really realized what was going to happen. But at least through that period, it was really a downward shift in short-term expectations, not long-term.
Yeah, that's really interesting that short-term went down, long-term went up a little bit. It's like like they believed in momentum, but also understood that expected returns increased.
Right. But not too much, because I would have thought, given the size of the stock market crash through April, I think it was down 50%, 60%. Do you remember the exact numbers? It was pretty sizable, and
it was big. Yeah,
this number should have gone up more.
What impact did pre-crash, so before the crash, optimism or pessimism, like we talked about those kind of steady states that people in your sample have, what impact did that have on whether people sold out of equities after the crash?
Well, roughly speaking, there wasn't a lot of selling, actually. Well, this is a general rule in buy and hold investors, even based on a severe market shock like this. 70% of investors didn't do anything, 30% did. The optimists were more willing to trade than the pessimists, but the optimists also had a bit more in equities anyway. They had higher 60% allocation, average equity allocations, as I recall. So, for example, of the optimists who traded, okay, so that's roughly 30% of them, they shifted about 4% of their portfolio on average. Now, clearly some moved more, some moved even smaller amounts. The pessimists shifted 2%. So it was almost, even among the traders, the shifts were, I don't know, what would you describe them as? Microscopic?
Yeah, small for sure.
Yeah, small for sure. And it was almost like, okay, the market's declining. I think I might sell out a bit. Yeah. Among the traders, again, the 30% who were traded.
So sorry, they were trading away from equities in both camps?
Yeah. Pretty, and both sides, yeah. Now, I will say this, that's the net movement. Gosh, I don't have the gross movement in front of me, and I think it's in a spreadsheet somewhere. I don't know that we published it, but we know from prior experience that although the net movement was away from equities among all traders, there was a group of people who were trading into equities. So it's this was the net movement of optimists away from equities, but there probably were some optimists who were buying as well. So so it's important to realize it's, markets are two-way, so there's always people on the other side of the trade.
Right. Of course. And what do you think are the lessons for investors in how pre-crash beliefs affect selling behavior after the crash?
Well, a lesson from this crash was like, don't do anything, right? It's a lesson from
So quick.
most
Yeah.
crashes. Um, and I suppose the other lesson I would take away from this, if you're going to do anything, don't do too much of it. This is actually a long-standing belief. I remember back way in, 25 years ago when I was reviewing first draft of Jack Bogle's Bogle and Mutual Funds book. There was a chapter on asset allocation, and I had been doing some work on that for some reason. And I read the chapter, and even I think Jack at the time was writing it sort of like, if you're going to trade, don't trade too much. This idea of kind of swapping in and out of the market based on tactical beliefs was sort of verboten at Vanguard. So I think you see that sort of reflected in the messaging to clients. If you're going to trade, make small trades. And I still believe that personally as well. It's otherwise too damaging. And by the way, the optimists, who oversold made a mistake, obviously. Yeah.
It's really interesting that the optimists reduced their equity on net by 4% and pessimists by
Yes.
2%.
Yeah.
So the optimists reduced their equity by more, but they had a higher equity allocation to start, though.
That's right.
Huh.
But yeah, and again, underlying that, and I wish I had the numbers, but there's some group of optimists who are increasing, which means that
Right.
the optimists who were decreasing were doing more than 4% on average. And let's say that was
Right.
10%. Let's just make that 10% for the moment. Just making that up. They then subsequently in April traded more back into equities.
Huh.
So
I actually did this. I did exactly that. I think I was 80-20 in my portfolio, 80% equity, 20% fixed income at the time, not across my whole portfolio, but in one of my accounts. And I managed to bottom tick the crash and went from 80-20 to 100% equity. Just dumb luck, but I literally bottom ticked it to the day and have been 100% equity.
congratulations.
Well, I didn't really do much, I think, long term, but it was just kind of a funny thing. So you talked about traders, optimists who were moving the other way, and it's just funny that I happened to have been one of them by luck.
There's a senior thought leader within Vanguard at the time, I'm not going to give his name, who did exactly the same thing and crowed about it for weeks afterwards.
I don't think I told anybody about
And we're
that.
like, this is not the advice we give the class. We say, stay the course. He said, yes, but no one said overinvest in equities when they're down. He said, we're
that's too
silent on
funny.
that question.
Yeah.
That's too funny.
Yeah, that's
I was already 100% equities. I had nowhere to go except using leverage, which I did not want to do.
I was going to say that's the next move, I guess.
Yeah.
well, based on that earlier discussion we had prior to the podcast, you're going to stay that way the rest of your life, right? So you won't have any choice to make.
Yeah, that's listeners will know we're talking about the Scott Cederberg paper, which I've reviewed the updated draft of. It's not out yet, but by the time this episode comes out, it will be out, and everyone will have been very excited to read it. Okay, I want to move on to your other survey paper on ESG. What survey motivations do people give for investing in ESG assets?
Well, this is actually we were using the same bi-monthly survey infrastructure, but we decided we'd add a few questions because it was a hot topic in 2021. And by the way, I do have to thank Xiao Shu at Vanguard and Joe Tan at Yale. They also helped on this project. They were part of this effort. Anyway, so we decided to add these questions because you know what? No one really. It's so funny. I even today when I watched the discussion about ESG, no one cites any data. I wish they would cite this paper on what actual investors believe. It's all about extreme points of view. But as you imagine, in any marketplace, there are 2 points of view, if not more, on any particular issue. So we added these questions on ESG. First of all, we thought to ask, are ESG factors important or not in your investment decision making? And it was about 50-50 split. 45% not at all, 55% said could be partially or somewhat or fully. Among the people who believed in ESG, it was very interesting. The dominant reason was the ethical aspects, do the right thing. The second dominant reason was climate change. Forget the S and the G. It's all about E, and not just all E, but climate change E. And then there's a small group of people who said, oh, it's just a way to make money. Um, the reason why I'm investing in ESG, and they had higher expected returns. The other two groups, the do the right thing and the climate change people, actually thought there was a penalty associated. On average, it worked out to be 1% a year return associated with doing the right thing or hedging against climate risk. But there was a group of people who, of that 55%, that small group, who believe that you're going to do better in the long run because all those stories about stranded assets and are going to come down to haunt all those stocks, and you're going to be on the right side of the return distribution.
That's really interesting because that seems like the two bigger groups, they have a taste for ESG and therefore should expect lower returns, which they do. And then the smaller group, maybe they have like a hedging motive. They think the climate's not properly priced and so therefore they expect higher returns.
Well, it's the climate and the do the right thing and the climate people both think there's a penalty. It's the people, there's actually a group of people say I'm investing in GSG just because my main reason is because I think it's going to have a higher expected return.
Huh.
Yeah, yeah. So it was a third group. Yeah. And so yeah, it's really kind of like the key point I continue to make in when I ever offer this question is to observe that there are two sides of the trade. There's some people who think it's important, some people think it's not. I mean, otherwise, right? You wouldn't expect that. And there are heterogeneity in beliefs, as we were saying. It's not all about necessarily doing the right thing. For some, it's just a pure climate hedge. That's the second most important.
Wow. And so how are ESG motivations related to portfolio behavior?
Well, you know, so first of all, there's a big caveat here. We only had like around 4% of holdings in ESG products because they were just being launched at Vanguard on the platform. And as you know, when you launch a product to a group of investors who are self-directed, it could take decades for it to be incorporated into their portfolios as they have new money, cash coming in, as they reconsider their portfolio allocations. So, but as a general rule, if you were more likely to, if you had any of these particular reasons, you're concerned about climate risk, you're more likely to be concerned about doing the right thing. You're more likely to invest in ESG products. You saw that even in a small sample. So I thought that was quite interesting. But again, it is a small sample because people are really, most ESG investors, when you looked at the construction of their portfolios, are using it as a sort of a minor portfolio holding. You rarely saw someone who had it in an all ESG stock portfolio.
You talked about the lower expectations that those two groups have. How important are financial returns to the investors with ethical and hedging motives?
Well, that's the interesting thing. If you take people who have non-pecuniary motives, but some people think, and among those group, on average, they thought they would do not as well in ESG. But within that group, there are some people who thought they would do better based on their expected returns. Because we actually asked them in this survey, because it was about expectations. We asked them about the expectation for ESG investments versus we had already asked them about the stock market. So we could compare the two. It turns out the more optimistic you were about the return prospects, the more you put in ESG. So I'm concerned about climate risk. And I don't think ESGs are going to do that well. I allocate a certain amount. If I'm concerned about climate risk, but I think ESG is going to beat other stocks, I'm going to put a lot more money into it. So it turns even among ESG investors, there's a differential based on financial expectations, which I found fascinating. It's a curious wrinkle.